But we begin with the Federal Reserve's plan to once again raise interest rates. It's an effort to curb the high prices on just about everything, but it also comes as mortgage rates are at highs not seen in decades. ABC News business reporter Alexis Christoforous joins us now with more. Alexis, this is the sixth time this year now that we're seeing rate hikes. What do you expect to hear from the Fed?
That's right. Sixth rate hike of the year, but fourth in a row. That could be 3/4 of a percentage point. So the Fed expected to still be very aggressive in its fight against inflation. What these higher rates are supposed to do is make borrowing money for businesses and consumers that much more expensive. In doing so, the Fed wants to slow the economy to the point that it will bring down prices and start to lower inflation. So what does that mean for everyday Americans? We've got a couple of examples for you, and one is the housing market, where we're really seeing this start to take hold. So if you had taken out a mortgage for $300,000 just a couple of months ago, you would have been paying a rate every month of about $1,700. Now, with the current interest rate at 7.08%, that's a 20-year high, you're paying more than $2,000 in a monthly payment. That's more than $278 a month for the same house, for the same loan. Let's talk about more credit cards. The average credit card balance, $6,200. If you're making minimum payments, today's rate hike, if it is indeed 0.75%, means you're going to be paying an extra $366 over the life of the loan. I think the big takeaway there is if you can pay more than the minimum each month, do it and try to get down that debt.
Yeah, not a good time to take on debt. The rate hikes are aimed at countering inflation, but Mark Zandi, the chief economist at Moody's, he says, he tells ABC that these hikes are actually hurting the economy, and he's pointing to, as you mentioned, driving up mortgage rates, hurting housing demand and prices, driving stock prices down, and impacting consumer spending. What's your take?
My take is that's exactly what the Federal Reserve wants to have happen. I know that that's hard to believe, but the Fed wants the housing market to start to cool off. They want us to continue to pull back on our consumer spending. They believe it's the only way businesses will be forced to push prices lower. So far, we haven't seen it, and a big reason why that job market continues to be very strong. This week, we found out there are 10.7 million job openings, roughly 2 job openings for every person out there looking. So it continues to be a tight labor market. Wages have to continue to be very competitive in order for businesses to hold on to workers.
What does this all do for the prospects of a recession?
With each passing interest rate hike, the odds of a recession continue to grow. And, you know, all of these rate hikes have a lag effect on the market, so we still haven't really felt it all yet. Many economists expect there to be a mild recession at some point in 2023. Unfortunately, the recession would come before we really see lower prices, so there is going to be some pain in the interim.
All right, Alexis Christoforous, always great to have you. Thank you.
Thanks.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.